Good morning, folks. Welcome back. Happy Monday. Pretty eventful week last week. A lot of craziness in the markets, right? Mostly trailing Nvidia and the fantastic earnings they reported. A lot of enthusiasm on the sidelines. There's been a lot less retail activity this year, especially compared to the COVID era, right? Where everyone was sitting at home, had maybe some extra cash or some stimulus payments, and got into the stock market and started jumping into things, whether it was Wall Street bets or whether it was just thinking more about their personal wealth during that period of enormous uncertainty, right? And now we're in another era where we're sort of paying, we're paying our credit card bill on easy money, easy conditions through COVID and even before COVID when money was very cheap. And this takes us to what people tend to fixate on an annual basis, which is this Jackson Hole meeting. It's become more and more popular or noted in the last several years because it's this odd occasion where central bankers of the world come together and sort of swap views, or at least speak their views in front of one another in an uncharacteristically kind of calm and isolated place, especially if you're from outside of the United States. So always a fixation amongst the financial press. Unfortunately, this morning, it's basically a nothing burger. I mean, the only takeaway from the meeting was basically Jerome Powell indicating that he's happy to and is looking to continue to raise interest rates as Fed Open Market Committee meetings occur in order to stamp down inflation that's above target. Here's sort of the irony of this, right? It's that now inflation is around 3%, 4% on an annualized basis. He wants it near 2. There's talk that they'll raise it to 3. But if we take a step back, 10 years plus, we see a Federal Reserve that wanted 2% inflation and we weren't getting it in the economy, and they didn't do anything about it. They didn't tighten rates or they didn't create economic conditions to make prices go up. They kind of let themselves fail. This time around, it's kind of the opposite. They're not willing to let themselves fail whatsoever because the risk of rampant inflation is so high and it is such a destructive force in the economy that it makes perfect sense for a central banker to really want to make sure that the cockroach is dead if he can use all the tools he can. So, again, a boring sort of central banker interest rates yield conversation, but it is at the center of absolutely everything. And investors know this, and you see the reactions in the market. Last year closed green. We had that central banker meeting. The market is looking like it's going to open green, but the consensus, from my conversations, across industry people over the weekend has been that, we're probably going to see a little bit of a sell-off reacting to the hawkishness that we saw from Jerome Powell, head of the Federal Reserve. Hawkishness meaning willingness to raise rates and a general kind of negative outlook on the economy. Now, there are some glimmers and shimmers of information in the real market, right? We actually saw a pretty weak employment report and coming in below estimates, telling us there may be a little bit of an employment slowdown. I think we can chain that all the way back to the large companies that have been cutting staff all year, and finally it's hitting more of the middle of the market. We'll continue to monitor that as we always do. There's also mixed results coming out of this earnings period. You have companies like Nordstrom indicating that they don't have a good outlook. They didn't do very well this quarter. But then you have the Gaps of the world that outperformed under tough conditions. So the way I see it, and actually while I'm talking, I'm going to try to get a chart up here for you. I should have done this earlier. But, when you see that outperformance, that's something to look for. And what I really love is when conditions are bad and you start to see companies that perform very, very well. So let's see if I can pull this off. There we go. Nice. Magic chart. So here is a little bit of GDP estimates for 2023 this quarter. So it looks like the Fed is adjusting up, right, which is pretty good. But the top 10 and bottom 10 in the blue chip world are actually adjusting down. So this speaks to, we don't have to look at my face, we look at the chart. So this speaks a little bit to what I'm talking about, where conditions are a little uncertain. They look quite positive overall, especially looking at across July and August. But some of the best companies in the market aren't loving this. they're giving mixed results. Examples, like I mentioned, Nordstrom. Another one is Nike. Apple giving kind of a cautious outlook for the rest of the year. So there's a little bit of deviation in perception. This is fantastic because it gives us the ability to, I'll close this now. This gives us the ability to find winners and losers within, certain industries and certain markets. And that's a lot of fun, but that's called stock picking. But stock pickers haven't done so well this year. Now, if you've picked the right stocks, right, if you were all in on Nvidia this year, or you were all in on Facebook, you did really well. But there's 500 companies in the S&P. There's tons of other companies across other indices. How do you pick the right stocks, or how do you pick the combination of stocks that don't cancel each other's returns out, because you could pick a stock that does 100% in a year, but then it's paired with a stock that loses the majority of its value this year. We can talk about the Better IPO that we saw last week. I don't know if any of you saw that video over the past few years of this startup CEO firing all his employees via Zoom in a very crass way. Same CEO took his company public via a SPAC. Won't jump into what a SPAC is, but don't stay away. And the company lost like 99% of its value upon its debut. So stock picking, very tricky. It is for experts. It is for hedge fund managers. It's for people looking for risk. Now, that leads us into investing styles. And in moments of uncertainty, both in the big picture, the macroeconomic picture, as well as, maybe moments of uncertainty within an industry, like there's some new rules coming up, for example, crypto. This is a wonderful environment to apply a variety of different investing styles, and I wanted to summarize some of them. So we already touched on stock picking, right? So stock picking is simply, you think that out of the thousands upon thousands of companies that are traded publicly, whether it be in your country or another, you have the discerning eye to be able to find the diamond in the rough and generate returns way greater than the index. Now, let's take a step back and look at Nvidia. Nvidia realized a 200% gain and was also responsible for the majority of the gains within the index that it lives inside of. So, the S&P 500 has 500 companies. If the company that is performing the strongest is responsible for the majority of the growth of the entire basket of 500 companies, it's tough to pick stocks. I mean, if you pick that one stock, you've done great, but what are your odds of picking that one stock? A professional investor will conservatively tell you that I've got probably at least a 1 in 250 chance, because he's saying that half the companies in the index don't, fit his profile. And then if he's focusing on an industry, he'll say, I've got a 1 in maybe 50 chance. And then you go on and you try to combine the best picks to beat the index. Nobody beats the index. Extremely few people beat the index. But that's why good hedge fund managers make a lot of money and good stock pickers get quite a bit of fame. The next strategy I want to talk about is quantitative. It's the quant investment strategy. Typically, investors in this style will use software to look at all of the stocks or investable assets in the universe that they want to play in, and then they analyze the group data. And they go into the analytics. They see what are the default risks of certain groups and what are the profiles of certain industries and sub-industries. And then they try to find certain factors, right? Certain correlations between those groups of stocks and things that happen in the market or the economy that affect them. And then they optimize these groups of stocks to hedge negative factors and boost positive factors. It's a very quantitative approach. It's sort of a statistical analysis approach, and there's not as much attention paid to individual stocks in this strategy. There's a lot more attention paid to factors and analytics. They try to find companies with certain characteristics at a high level, looking at a ton of data and being able to analyze that through, proprietary models that they may have. So it's kind of a high level statistical approach to investing, and it tends to work well when there's a lot of uncertainty or there's a lot of volatility in a particular area of the market where risk and premium is pooling. So that's quant. And then the next one I wanted to touch on, and we'll wrap up here, is value investing, which, as you know, it's funny how during kind of uncertain times people revert to value investing. They revert to Benjamin Graham's The Intelligent Investor and investors like Warren Buffett, and now some additional ones that are catching some hype on Twitter. And so we're seeing a little bit of I've noticed a little bit of a renaissance of the sexiness of value investing, the most unsexy style there is, which is basically analyze companies and uncover where there's a disconnect between the actual value of the company on the books and what it's being priced at in the open market. It's very straightforward, but it is very challenging to sort of stick to your convictions and stick to the plan. And I think that right now is a great moment to apply. I think it's always a great moment to apply the value investing framework, but particularly when you see things like the magic chart I showed you. You see this deviation between macroeconomic perceptions and perceptions of some of the best companies. These are the moments where, hey, there's probably some disconnect in pricing. There's probably some deep value that I can find somewhere in an industry that investors are scared of, or maybe a particular brand that is having a tough moment, or a company that's experienced some kind of unusual setback or off-cycle issue that's driven investors away. So value investing is another one. There's many more. There's like more exotic strategies, delta neutral, long short, hedge funds where they come up with a thesis and then they try to juice up that thesis as much as possible using derivatives and stuff like that. But plenty of investment styles. There's a degree of uncertainty. Again, I'll reference the chart one more time. Oh no, that's not the chart I wanted to. I thought it was the same one. But there's another one. Yeah, right here. This shows Euro and USD, right? So the dynamic between the two. And look at this, up and down. In the near term. I mean, this shows us a great degree of uncertainty, right? And essentially a flat path. And when you start to see these patterns occur in the sort of macro level of the economy, in FX, in GDP analysis, in growth numbers, in consensus between companies, those are the pockets where investors can go in and start hooking, sinking their teeth into situations that are a little disjointed because of the lack of consensus in the market. So hopefully that was helpful for you guys, fun, interesting. We'll catch up on Wednesday. I imagine a lot is going to go down this week. We're going to continue to digest earnings, continue to digest comments from the central bank. And so stay tuned and join the Discord. If you haven't, ping us, write us, comment, however, any way you want to get in touch with us, you can, and we will respond. Feel free to join. Take care, guys.